48 hours, that is the amount of time Donald Trump gave Iran this weekend to fully open the Strait of Hormuz. And these are his exact words, the United States will obliterate Iran's power plants, starting with the biggest one. Iran's response arrived within hours. The Revolutionary Guard stated publicly that if the United States executes that threat, the Strait of Hormuz will be completely closed, not partially, not temporarily, completely, and every piece of us linked energy infrastructure in the entire Middle East will be targeted for destruction. As you watch this video, that 48-hour clock is running, and the financial markets, which are always ahead of the politicians, always pricing in what comes next before the press conferences catch up, are telling you exactly what they think about the outcome. Brent crude crossed $112 per barrel this morning. UK government bond yields hit their highest level since 2008. German bond yields hit their highest since 2011. The S&P 500 is heading into its fifth consecutive losing week. The VIX Wall Street's fear gauge has surged past 25. Global equity markets are in free fall. The markets are not reacting to what has happened. They are pricing what happens if the trigger gets pulled, and what they are pricing is not a correction. It is a potential restructuring of the entire global energy and financial system. Stay with me, because what I am about to show you is not panic and it is not speculation. It is a pattern, a mechanism, a system that has repeated itself with precise consistency every single time in recorded history that a dominant military power has threatened to destroy a critical global energy choke point, and the outcome of that pattern every single time has been catastrophic for the people who were not prepared, and generational wealth creating for the people who were. Let me explain the mechanism first, because understanding the mechanism is what separates the people who see what is coming from the people who are standing in the path of it. The global economy runs on oil, not metaphorically. Literally, every product you buy, every flight you take, every piece of food on your table passed through a supply chain powered by petroleum at some point, and approximately 20% of the world's entire daily oil supply, roughly 17 million barrels every single day, passes through a stretch of water 30 miles wide between Iran and the Arabian Peninsula. The Strait of Hormuz, 30 miles, that is the single point of failure in the entire global energy system. Now here is what makes the current 48-hour ultimatum categorically different from every previous Middle East crisis of the last 50 years. Every previous escalation, the 1973 oil embargo, the 1979 Iranian Revolution, the 1990 Gulf War, the 2019 Aramco strikes, was a threat to reduce the flow through that strait, a partial disruption, a supply shock that the world's strategic petroleum reserves and alternative supply routes could partially absorb. What Iran is now threatening is not a partial disruption. It is complete closure. Zero flow, not reduced flow, no flow. For the first time in the history of the petrodollar system, a credible military power is publicly threatening to shut off 20% of the world's oil supply entirely, and the United States president has responded. Not with diplomacy, not with sanctions, but with a 48-hour ultimatum backed by the explicit threat of military strikes on civilian infrastructure. This is not a normal geopolitical crisis. This is a binary moment. Either the 48 hours pass without military action and the world exhales, markets recover, and the crisis continues at its current elevated level, or the trigger gets pulled. And if the trigger gets pulled, every financial model, every economic forecast, every market valuation that has been built on the assumption of continued global energy flow becomes instantly obsolete. History has seen moments like this before, not many, but the ones that occurred all follow the same pattern, and that pattern has never once produced a good outcome for the people who were not positioned for it. Stage one is always the build-up. A dominant power and a challenger power reach a point of direct confrontation over a critical resource or trade route. The dominant power believes its military superiority will force the challenger to back down. The challenger calculates that the cost of capitulation is higher than the cost of escalation. Both sides are reading a different version of the same situation. The dominant power sees a bluff, the challenger sees an existential threat. Stage 2 is the miscalculation. One side acts on its assessment. The other side responds in a way that was not fully anticipated. The crisis crosses a threshold that neither party had fully modeled. The action and reaction cycle begins. And once it begins, the logical off-ramps that seemed obvious before the first strike disappear. Because the political cost of de-escalation rises with every exchange. The leader who backs down after the first strike looks weaker than the leader who escalated in the first place. Stage 3 is the economic cascade. This is where most people are completely unprepared because they are watching the military dimension and not the financial one. When a critical global supply chain is disrupted, genuinely disrupted, not just threatened, the cascade moves faster than almost anyone predicts. Insurance markets reprice. Within hours, shipping companies halt transits within days. Refiners that were operating on just-in-time delivery schedules find themselves without feedstock within weeks. The price signal oil at $200, $300, potentially $400 per barrel in a full closure scenario moves through the economy not just as higher energy costs, but as a fundamental repricing of every good and service that depends on energy, which is every good and service. Stage 4 is the restructuring. The world adapts, alternative supply routes are found. Strategic reserves are deployed, political negotiations eventually produce some form of resolution. But the world that emerges from the adaptation is not the same as the world that entered the crisis. Supply chains have been redesigned, trade relationships have been reorganized. The financial positions of the parties involved, the winners and the losers have been permanently reset for stages. Every major energy supply crisis in modern history, no exceptions, let me prove it. The year is 1973, the Yom Kippur War. Arab members of OPEC announce an oil embargo against the United States and other Western nations that had supported Israel. The embargo is not a closure of the strait. It is a supply reduction, a partial restriction on a portion of global oil flow, not complete closure of the world's most critical choke point, a partial restriction. The result, oil prices quadrupled in 3 months, from $3 per barrel to $12. The United States economy entered a recession that lasted 2 years. Inflation surged to double digits. The stock market fell 45%. Lines formed at gas stations across America. The economic damage from this partial supply restriction lasted not months but years. The inflation that was ignited in 1973 was not fully extinguished until Paul Volcker raised interest rates to 20% in 1981, 8 years later, and caused the deepest recession since the Great Depression in order to do it. That was a partial restriction from a partial coalition of some OPEC members against some importing nations, with the strait itself still fully open. Check, verified, undeniable. The year is 1979, the Iranian Revolution. The Shah falls, Ayatollah Khomeini takes power, Iran's oil production collapses from 6 million barrels per day to under 2 million. Iranian oil not strait closure. Iranian production reduction removes roughly 4% of global supply. The result, oil prices more than doubled in 12 months. The United States economy entered back-to-back recessions. Inflation hit 13%. The Federal Reserve was forced into the most aggressive interest rate tightening in American history. The 30-year Treasury yield eventually hit 15%. The bond market was devastated. The stock market lost 30% of its real value. An entire generation of middle-class savings was eroded by the inflation that followed. That was 4% of global supply removed from a production collapse, not a strait closure. Check, verified, undeniable. The year is 1990. Iraq invades Kuwait. Saddam Hussein threatens to extend the conflict into Saudi Arabia, the world's largest oil producer. Oil prices doubled in 4 months. Global financial markets went into shock. The recession that followed was described at the time as the most directly oil-caused. economic contraction since 1973, George W. Bush assembled a 34-nation coalition to reverse the invasion specifically because the economic consequences of allowing Saddam to control Middle Eastern oil were too catastrophic to permit. That threat was too Saudi production. The strait remained open. Check, verified, undeniable. Now consider what we are looking at today. Not a partial embargo, not a production reduction, not a threat to a single country's output, a direct public ultimatum from the President of the United States threatening to destroy Iranian civilian infrastructure responded to by Iran's Revolutionary Guards with a publicly stated commitment to completely close the strait carrying 20% of global oil supply and to destroy all US-linked energy infrastructure in the region. S&P Global Zone Analysis published this week models the scenario where Brent crude averages $200 per barrel in the second quarter of 2026 if the strait remains closed through April, $200. The current price is $112 and already the UK's bond market is at its most stressed. Since 2008, the distance between what happened in 1973 from a partial embargo and what is now being threatened is not linear, it is exponential, and the financial system into which this shock is arriving is not the financial system of 1973. It is a financial system sitting on $39 trillion of U.S. national debt. With a Federal Reserve already trapped between the inflation from the current oil price and the recessionary pressure from the economic slowdown, a financial system where the S&P 500 is trading at Shiller P/E ratios only previously seen in 1929 and 2000, a financial system where China is already in deflationary crisis and where global bond yields are spiking simultaneously. This is not one crisis landing on a healthy system. This is the most dangerous potential shock in a generation landing on the most fragile system in a generation. Now let me address the three arguments that people are making right now to dismiss what the markets are clearly pricing. The first argument is that this is all just rhetoric, that Trump is bluffing, that Iran is bluffing, that the 48 hours will pass, some face-saving diplomatic formulation will emerge, and the crisis will de-escalate as it has so many times before. This argument may be correct. Crises often de-escalate. The Cuban Missile Crisis of 1962 came within hours of nuclear exchange and resolved peacefully. History is full of moments where the worst did not happen. But here is what this argument gets dangerously wrong when applied to financial preparation. De-escalation is a possible outcome. It is not the only outcome, and the asymmetry of the consequences of de-escalation costs you a modest opportunity cost from defensive positioning. Failing to prepare for escalation can cost you a catastrophic and irreversible portion of your wealth. Means that dismissing the risk because it might not materialize is the most expensive cognitive error you can make. Every person who watched the 2008 financial crisis unfold dismissed the warning signs as too extreme to actually happen right up until the day Lehman Brothers filed for bankruptcy. The dismissal did not protect them, it exposed them. The second argument is that even if escalation occurs, the United States military will resolve it quickly, that American naval power and air superiority will reopen the strait within weeks, that the disruption will be short and manageable. This argument fundamentally misunderstands Iran's asymmetric military strategy. Iran has spent 30 years specifically designing its military capability for one purpose: to make the Strait of Hormuz ungovernable by any outside power at acceptable cost. Sea mines that cost tens of thousands of dollars can sink vessels worth hundreds of millions. Iran has thousands of shore-based anti-ship missiles positioned along its Hormuz coastline. It has fast attack boats. It has submarines. It has the capability to plant mines across the strait faster than they can be cleared. Clearing a minefield in contested waters while under fire from shore-based missiles is not a quick operation. It is a months-long process even with the full resources of the U.S. Navy deployed, and every day that process continues, the oil that should be flowing is not. The 2019 Abqaiq attack, a single drone strike on Saudi Arabia's most critical oil processing facility, took 5% of global supply offline overnight. It took Saudi Arabia weeks to restore full production. That was one facility. A straight closure is not one facility. It is the entire 20% of global supply, simultaneously disrupted and contested. The third argument is that strategic petroleum reserves will cover the shortfall, that the United States and its allies have enough stored oil to bridge a temporary supply disruption without catastrophic consequences. Strategic petroleum reserves exist precisely for this scenario. The International Energy Agency's combined member reserves represent approximately 1.5 billion barrels, roughly 15 days of global consumption. A useful buffer for a supply shock measured in weeks, but a completely inadequate buffer for a supply disruption measured in months, and the oil shock scenario that markets are pricing is not weeks. S&P Global's stress test runs through the second quarter of 2026 with Brent at $200 per barrel. No strategic reserve in the world bridges that gap. The math does not permit it. So what does this mean for your money right now? First, understand the specific inflation dynamic that a complete strait closure creates and how it is different from every inflation scenario of the last 30 years. The inflation of 2021 to 2023 was demand-driven, too much money chasing too few goods. The Federal Reserve had a tool for that: raise interest rates. To reduce demand, an oil supply shock of this scale is supply-driven. Raising interest rates does not produce more oil. It does not reopen the strait. It does not reduce the price of energy that is scarce because the supply has been physically cut off. The Federal Reserve's primary tool is useless against this type of inflation, and using it aggressively, raising rates to fight oil-driven inflation risks crushing an economy that is already slowing. The Bank of England this week voted 9-2-0 to hold rates while explicitly acknowledging stagflation risks for the UK. The Fed is in the same trap. Markets are now pricing the possibility of Fed rate hikes this year, not cuts. A hiking cycle into a supply shock recession is the definition of stagflation. And stagflation is the one economic environment where almost every conventional investment strategy fails simultaneously. Second, understand what gold is actually telling you right now. Gold fell 3% last week to below $4,500 per ounce. This is counterintuitive in a crisis. Gold should rise, not fall. But the reason gold is falling while everything else is also falling is a forced liquidation dynamic, institutional. Investors facing margin calls and redemptions are selling their most liquid, profitable assets first. Gold has been one of the best performing assets of the last 2 years. It is being sold to cover losses elsewhere. This is not a signal that gold is losing its safe haven status. It is a signal that the broader financial stress is severe, enough to force selling even of defensive assets. Historically, forced liquidation in gold during early crisis phases is followed by dramatic appreciation once the immediate liquidity pressure passes and investors begin rebuilding defensive positions. In 2008, gold fell 25% in the first phase of the crisis. Then it tripled over the next 3 years. The mechanism is the same. The entry point created by forced selling during the acute phase is historically one of the best risk-adjusted opportunities in a crisis. Third, understand the specific equity sectors that face the most severe downside in a prolonged high oil environment. Airlines face a direct and devastating cost structure impact. Aviation fuel is their largest variable cost. They have almost no ability to reduce fuel consumption without reducing flights. In a $150 oil environment, several major carriers face insolvency. Consumer discretionary, anything people stop buying when their disposable income is consumed by higher energy and food costs, faces demand destruction that will not be visible in earnings for 1 to 2 quarters but is already in motion at the consumer level. Technology. Companies with massive data center energy consumption face cost pressures that are not currently reflected in their valuations, and any company with highly leveraged balance sheets faces the double pressure of higher operating costs and higher interest rates simultaneously. Fourth, and most importantly, think about the geographic dimension of this crisis in a way that most Western financial media is completely failing to cover. The countries in deepest danger are not the United States and Europe. They are the large Asian energy importers. Japan, South Korea, Taiwan, India. These economies import the vast majority of their energy from the Gulf. They have limited domestic production, limited alternative supply sources, and limited ability to absorb the cost shock of oil at $200 per barrel. Japan's already fragile fiscal position, debt to GDP above 260%, becomes acutely dangerous if energy costs triple. South Korea's export-driven economy, built on energy-intensive manufacturing, faces a competitiveness catastrophe. Taiwan, and this is the dimension that almost no one is discussing, faces energy cost pressure at exactly the moment China is engaging in what analysts are calling crackdown rhetoric over the Taiwan Strait, and economically pressured, energy-stressed Taiwan is a more vulnerable Taiwan. The geopolitical implications of this Middle East crisis extend in directions that the current coverage is not capturing. Fifth, think about the concept of optionality in a binary moment. When a situation can resolve into fundamentally different directions, de-escalation or escalation, and the financial consequences of those two directions are as divergent as they are today, the rational positioning is not to make a large concentrated bet on one outcome. It is to hold assets that preserve value in both scenarios and have exposure to assets that dramatically appreciate in the escalation scenario. Cash provides liquidity for both outcomes. Short-duration inflation-protected instruments provide partial protection in both outcomes. Hard assets, gold, commodities, energy producers provide dramatic upside in the escalation scenario at the cost of modest underperformance in the de-escalation scenario. Long-duration bonds and highly valued growth equities are the assets that lose dramatically in the escalation scenario and only partially recover their opportunity cost in the de-escalation scenario. The asymmetry of those payoffs in a binary moment suggests a clear directional logic. Let me tell you exactly what the historical record says about 48-hour ultimatums in geopolitical crises. Sometimes they are followed by compliance. The Cuban Missile Crisis ended with Soviet ships turning back before Kennedy's naval quarantine line. The 1994 Haitian crisis ended when a U.S. military delegation landed in Port-au-Prince and the junta agreed to step down before the invasion fleet arrived. Sometimes they are not. The ultimatum to Serbia in 1914 that was not fully accepted triggered the First World War. The ultimatum to Iraq in 2003 preceded the invasion that reshaped the Middle East for a generation. The pattern of outcomes is not uniformly catastrophic, but the pattern of financial consequences when ultimatums escalate rather than resolve is uniformly severe, and the financial system that would absorb an escalation today is not the system of 1973 or 1990 or 2003. It is a system simultaneously carrying the weight of $39 trillion in US national debt, a Federal Reserve with no good options, a stock market priced for perfection, Chinese economy in deflation, and global bond yields already at multi-decade highs. The clock is running. As you watch this video, the 48 hours that began Saturday evening are expiring. The financial markets that opened this Monday morning have already given you their assessment. Fifth straight week of losses for the S&P 500. UK gilt yields at their highest since 2008. German bond yields at their highest since 2011. Oil at $112 and rising. The fear gauge above 25. The markets are not panicking. They are pricing. And what they are pricing is a world in which the probability of the worst outcome has risen to a level that cannot be ignored. The people who recognized in 1972 before the embargo that the United States had made itself structurally dependent on foreign oil in a volatile region and had positioned accordingly emerged from 1973 with their wealth not just intact but multiplied. The people who recognized in 2007 before Lehman That the financial system's leverage had reached a level that any shock could unwind catastrophically, and who reduced their exposure accordingly, had cash available to by the bottom of the 2009 crash, the people who recognized in 2019 before the pandemic that supply chains concentrated in single geographies, created catastrophic fragility, who diversified accordingly, ready when the disruption arrived. In every case, the warning was visible before the event. In every case, the people who acted on the warning were the ones who had the most options when options mattered most. The warning is visible now. The 48-hour clock is running. The markets are telling you what they think the distribution of outcomes looks like. The historical record is telling you what those outcomes have looked like every previous time they have occurred. The only question left is the one that every major crisis in financial history ultimately reduces to. Are you positioned for what happens if the trigger gets pulled? Or are you assuming it will not be? Because history does not grade on the curve of optimism, it grades on the accuracy of your preparation. If this analysis helped you understand what the 48-hour clock actually means for your financial future, then there is one thing to do right now: subscribe, because the next video in this series tracks this situation in real time. We cover exactly what the financial signals will look like in the first 24 hours after any military strike, which markets move first, which assets decouple from the broader sell-off, and what the playbook of the world's largest macro hedge funds looks like when a binary geopolitical moment resolves into the escalation scenario. The clock is running. History says be ready before it stops.